What is up, guys? Today I'm going to be explaining this 500 pip move on gold. So the reason is actually a little more sinister than you would think. At least that's what I think. And I'm going to try to explain what I believe and why I believe this to be the case. So definitely stay tuned. Let's pay attention. And I challenge you to open up your minds and try to understand where I'm coming from. This is my opinion. This is my perspective. And it's why at least I'm able to what I believe properly analyze this market. Let's go. So the first thing we have to uncover is what is gold's demands? What is gold's direction? What does it want to do? And before we make any analysis, a lot of your analysis, you would think that is something that you view on the chart. But something that I have realized is a lot of the things that are very important for an analysis to be created and for it to be effective aren't visual. They're things that are left unseen, right? But they're definitely there. What I want to do is identify what goal is up to. And you can do this from a few different things, but I tend to ask a few questions of the market, proper investigative data gathering. And what I'm actively looking for is the answer to two questions. Where's gold going? And where's the money? Gold is very interesting because gold is something that once it begins to move, it's very, very rare for it to stop, at least right away. And I can tell you, I did not foresee a 500 pip move until I saw what I saw. And I want to talk about that now. So the first thing I want to highlight is this area right here. I want to highlight this area because on the chart, what this is synonymous with is consolidation or accumulation, right? And consolidation and accumulation, what they are suggesting to us is the market is trying to gather orders, it's trying to gather contracts, it's trying to make people feel like it's going to buy when it's just going to buy up to a certain area, making the market feel like it's going to sell, and it's going to sell down to a certain area, and has people trapped within a range. Interestingly enough, there's a pattern that I like to trade, and it really looks like this. It really has it's a move, then it consolidates, it spikes out of the consolidation back against the move to a previous liquidity, and then it continues. Interestingly enough, we have thus far, at least on the chart, this is a replayed scenario, thus far we have a few of those elements on the chart, right? So we can quickly identify where's gold going. So before I draw anything here, right, before I actively draw anything here, we want to use a few different time frames just to clarify where gold might be going. So you can say that on the 50-minute time frame, it's bullish, and it seems to have gone into consolidation, but we wouldn't merely make that decision just yet. Let's go to the 1 hour. And you can identify that gold even is even more bullish on the 1 hour, all the way from, we can say from September, right, the 28th of September to present. It's even more bullish. And then if we go up even higher, we can say that, so it's been bearish prior, the year before, which will be last year, but it's kind of counteracting all of that bear move, that bear momentum, and now looking like it's going bullish. So let's go even higher. You realize what I'm doing is I'm asking questions and looking for the answer. If I go even higher again on the daily and I zoom out, it looks even more bullish. And the higher you go, the more bullish it gets. Gold is a bull market. That is clear as day. So because it's a bull market, I can quickly identify it most likely might be going up. I mean, if you even look at it on the weekly time frame, all of these signs point to buys, right? You even have rejection to the downside. Let's come back down. Let's walk our way back down the time frames now. And now I can quickly identify my consolidation or my consolidation range. So remember I told you that there's a move that looks like this. I'm going to draw it right here. So there's a momentum, and then it consolidates, and then it spikes out downward against the momentum to a previous liquidity, which in this case might be somewhere here, and then it makes its move. And interestingly enough, what you have to figure out is, where is it going? What this move? You see this here? See this? Is what I'm interested in figuring out. Because that is the answer to the question, where is the money? Or at least what I would like to believe, what is the answer to the question, where is the money? Why am I saying that? Because the money is trapped in liquidity pools. What are liquidity pools? Liquidity pools are areas in which the market has continuously bought off of, right? So it looks like a support. Maybe the market has sold off of this area. Maybe even you'd find like the market has had a lot of entries being triggered in this area, a lot of orders being triggered in this area. Anywhere that there's a massive amount of orders being triggered, stop losses being hit, take profits being hit, sell limits and buy limits being triggered, buy stops and sell stops being triggered, that is an area of liquidity. We can identify this on the chart by looking at it from a perspective of an area where a lot of traders are, an area a lot of traders are executing. So if I look at that on a chart, if I were to try to identify where one of those areas might look like, it might look like what you would call a support, but I would not necessarily consider it a support. I would probably look at maybe this area here. And I would probably also look at maybe this area here. And the reason why is these are areas where people would have been buying. However, the market never came back to these areas to take that liquidity out. What do I mean by that? Anywhere there's a massive amount of orders being triggered, and we know that there's liquidity trap there, we know that the market wants that liquidity because it can't continue without the liquidity. So let's just go back down the time frames to clarify. You can see that this wick here, this one, actively sought out the liquidity in this area. And I say that because even though the wick didn't reach this area, we can use the spread to kind of deduce, okay, maybe the dealer opened the spread just enough to grab orders in this area. So I would say that this area is a pretty high likelihood that it could probably try to get there. So what I would do in this case is I would set alerts on each of these zones. I would set an alert here, and then I would come on again, I would set an alert here, right? And what I'm actively looking for is the market to come out of the consolidation and maybe hit this area and go back up, or actively come out of this area and hit this area and go back up. Remember what the move looks like, right? You have momentum. We have the momentum prior. You have consolidation. You have the spike out against the momentum, to a previous liquidity, and then you move. So we have a few things that stand out to me, right? We have liquidity, potential liquidity. And I would say this because if I look to the left, there are a lot of orders in this area, right? The dealer has passed through this area, meaning buy stops would have been triggered, buy limits would have been triggered, sell stops would have been triggered, sell limits would have been triggered, right? So I'm looking at these two areas with a fine-tooth comb, right? I'm really paying attention to these areas, and I'm wanting to see how the alerts are triggered. Interestingly enough, this alert is triggered Monday. Now, remember I told you that there are elements to your analysis that aren't always visual. Something that kind of was important to me is the week in particular has a lot of news on it. We have FOMC this week, and that would have been yesterday. And we have NFP tomorrow, as of the date of this recording, which is the 2nd of February. So we have a lot of news this week. So my thinking is the dealer can probably use the news to disguise his move. Now, let me explain something to you very quickly, at least in my opinion. If the market wants to go here, it doesn't need news to do that, all right? If the market wants to go up, it doesn't need news to do that. The reason why I'm saying this is I'll do another video on news at some point, but we have to be very cognizant of the fact that news is a propaganda machine. It is designed to literally make people want to find reasons as to why the market moved. But it is also designed to misdirect you from why the market is really moving. You mightn't understand what I'm saying right away, and maybe you do, maybe you don't, but I can assure you, the news is only a disguise to the real move. The move is going to happen regardless. So, knowing that there'll be news throughout the course of the week, I'm watching to see how the market moves before that. I have a theory. Whatever the market does prior to the news, it is going to do the exact opposite during or after the news. So I went to bed and I had the alerts set, and I was doing my thing, sleeping, dreaming, hugging up my wife, etc., etc. And throughout the course of the night, this would have been Tuesday night, sorry, right? Or Tuesday morning, Monday night, Tuesday morning, right? The market actually broke out of the consolidation and it came to this area. And when it came to this area, let me zoom in a little bit. It did not stay in this area. It actually broke it immediately. And upon breaking this area immediately, I'm sleeping. It triggered my alert, but I'm sleeping, right? And it comes even further down to this area. And it comes even further down to this area around 5 a.m. And it starts to reject this area, right? And you can see the rejection. Or more so, I want to say this is exhaustion. What is the difference? Exhaustion is a move that occurs repeatedly in a specific area. So you would have price come down to a specific area and repeatedly reject like that, and then eventually move. Rejection is a very harsh, singular event that looks like that, both of which typically produce a move in the opposite direction. But it's important to know the difference between the two. Exhaustion is a repeated number of events in a specific area. Rejection is a very harsh, singular event. So we have exhaustion occurring at this area here. And that would have been around 8 a.m. No news, but this is happening around 8 a.m. And I'm saying, interestingly enough, it actually moved right off of that area. Now, if we stop and look at it, let's pay attention to it logically. From this low, the dealer moved the market just about 300 pips off of this low. Right? That's a significant move. Even if you weren't using a 10 pip stop, even if you were using a much wider stop, a 300 pip move is still a very significant move. Let's just say you were using a 30 pip stop with the right entry, that's still almost a 1 to 10. But I digress. So we have to understand that thus far, the pattern is coming to pass. You have momentum, consolidation, spike out of the consolidation to a previous liquidity, and then a climb. And then this would be Tuesday during the course of the day. Tuesday during the course of the day, it falls back and it starts to drop again, producing what seems to be a new consolidation, right? So it seems to be a new consolidation. So this new consolidation, it's now a micro setup. So let's go back to the pattern again. Remember what we want is momentum, consolidation, spike out of previous liquidity, and then a climb. Momentum, consolidation, we have to look for the previous liquidity. So where's the previous liquidity? If I'm using my brain, I'm seeing this area. And the reason why is if I look to the left, remember we said that anywhere there's a massive amount of orders, massive amount of traders, a massive amount of people executing, having their orders executed, it is likely that there's liquidity trapped in that area. So it's likely that the dealer will target that area so that he can grab liquidity from there and then climb. So it's literally a repetition of what we just did on a macro scale, on a micro scale. And you realize I'm staying on the 15-minute time frame because I have all of the data that I need from the higher time frames to discern the direction and all of that. But here's what I'll do. Before I confirm this analysis, I'm going to go back up on the higher time frames just to clarify, to make sure that what I'm seeing, I'm not missing out on anything else. Right? What a lot of traders will make a mistake with here now is they will ignore higher time frame direction. And what that does is, by ignoring higher time frame direction and higher time frame clues, you can be fooled. So let's go back to the daily time frame. So on the daily time frame, you have this big candle here suggesting that it did indeed reject the previous liquidity and is now suggesting that buys might be imminent. Let's go to the 4-hour. The 4-hour is suggesting some red candles. So these red candles, let's ask a question. What do 3 red candles in a row suggest? Bear momentum, right? A possible bear move. So that's good. That's good data. That's good intel. It actually does suggest that it could probably target. It could consolidate in this area a little bit and then target this previous liquidity to then climb. Right? Let's go to the 1-hour to see. The 1-hour looks even more like a consolidation, but definitely very, very bearish. Even having some black candles showcase signs of bullish rejection. So it's suggesting that it can indeed sell off to maybe this area. And what is very important is we are not just going to say, well, let's buy when it gets to this area. You know? What we are going to see is when it gets to this area, if it can reject or exhaust off of this area, then you look for your buys. So let's pay attention to what happened, because now this is Wednesday and we have FOMC this day. This will be yesterday in my time as of the time of this recording. So let's pay attention to what happened. And throughout the course of the day, it broke out to the consolidation a little bit. It came back in. And it's, for the most part, staying in this consolidation. It broke up, but it's still in the consolidation. And now, interestingly enough, it's targeted there, right? So let's pay attention to what happened. It targeted there again. And as it got its liquidity from this area, isn't that beautiful? Isn't that just beautiful? And if we look to the left now, where it would actually be targeting is this extreme high, the previous high. And if we're being honest, it broke the previous high. And now it's back into consolidation. So, interesting, you have a repetition of candles. You have now a new consolidation. This is literally live now. You have a new consolidation occurring. Maybe you can look to previous liquidity to see where it might target. But I'll leave that for a new day. What I want to just quickly highlight before we close off this is how far the move really went and how accurate the prediction was. That is over a 550 pip move. All from simply understanding direction, where's the money, where the market might try to go to get that money, and then a simple pattern. Let me know what you think. Let me know if you understand this or if you would like me to clarify a little more. If you have any questions, you know where to find me. My name is Brandon, also known as EkataTrading. Have a great rest of your day and rest of your week, and I will see you guys in the next one. Peace out, guys.